Welcome to Finance Trice, the world's modern broadcast hub for all things finance. From investing strategies to economic updates, from crypto insights to real world money lessons. Every broadcast is designed to help you think smarter, plan wiser, and grow strong.
Welcome to the deep dive. Today, we're really digging into something foundational.
Absolutely. We're exploring Benjamin Graham's The Intelligent Investor. But not just the book, we're using Jason Zweig's commentary too, to bring it into the modern world.
Yeah, the goal here is to find that solid ground, a shortcut maybe to financial knowledge that isn't overwhelming but actually works.
Exactly. A philosophy that's, held up, stood the test of time, even when other fancy ideas just crumbled during market storms. Graham wasn't preachy, but his principles, they delivered.
So the first big step is figuring out how not to be a fool with your money. And who better to learn from than Sir Isaac Newton? Seems counterintuitive, right?
It does. You think genius, you think gravity, calculus, but finance, he got burned. Badly.
How did that happen? He invested in the South Sea bubble.
He did. Got in early, made a decent profit, and got out. Smart move, you'd think.
Okay. So what went wrong then?
Well, he watched his friends. They stayed in, made fortunes on paper as the stock just went parabolic, from like 128 to over 1,000. FOMO, basically. Fear of missing out.
So he jumped back in?
Right at the absolute peak, poured a massive amount of money back in something like 20,000 pounds, which is astronomical then, and then crash. Lost nearly everything.
Wow. His quote about calculating heavenly bodies but not human madness really hits home.
It's the perfect illustration. The roar of the crowd drowned out his own considerable judgment, and that's precisely what Graham helps us fight against.
Which brings us straight to Graham's core definition. What is an investment?
It's very clear, very specific. An investment operation is, quote, one which, upon thorough analysis, promises safety of principal and an adequate return. 3 parts.
Sure.
Crucial.
Okay, let's break that down. Thorough analysis. What does that really mean in practice?
It means you actually have to understand what you're buying. The business, its financials, the risks. You can't just buy because, your buddy mentioned it or popped 10% yesterday. That's not analysis, that's gambling. Got it. Second part, safety of principal. This isn't just wishful thinking, is it? Not at all. It means you deliberately build in protection against serious loss. It's structural. It's that margin of safety concept we'll keep coming back to. You engineer the safety in.
And the third leg, adequate return. Why adequate? Why not shoot for the moon?
Because shooting for the moon, chasing those extraordinary returns, almost always means you have to break the first 2 rules. You skip the analysis, you forget about safety, you start speculating.
So investing done right is like a casino where the odds are stacked in your favor.
Exactly. As long as you stick to the rules that give you that edge. Speculation. That's just regular gambling, Vegas, the racetrack. Fun, maybe, but the house, or market volatility, usually wins in the long run. You make money for your broker, not yourself. Okay, that sets the stage really well. Now, Graham talks about 2 paths for the intelligent investor. It's less about what you own, more about who you are as an investor. That's a really critical distinction. You have to decide, are you passive, what he called defensive, or are you active or enterprising? And you need to know which one suits you.
Absolutely. You need some serious self-reflection here. You can succeed either way, but getting confused or trying to be both without committing, that's where people get into trouble.
All right, let's start with the defensive investor. Sounds less stressful.
It is, by design. This investor values freedom from worry, safety first. They set up a portfolio that basically runs itself. Think autopilot. Minimal effort, minimal excitement.
Like index funds and dollar cost averaging.
That's a perfect modern example. They accept a steady, maybe not spectacular, return for peace of mind. No constant tinkering, no daily market watching.
Okay, then the enterprising investor is the opposite. Pretty much. This person is willing and crucially able to put in real, intelligent effort. They're actively researching, selecting specific stocks or bonds, monitoring them constantly, looking for bargains the market missed.
So they're aiming to beat the market.
That's the goal. And the potential rewards are higher, definitely. But, and this is a big but, it takes serious time, skill, and emotional discipline. It's not for everyone.
And the danger, like with Newton, is blurring these lines, especially when things seem easy, like in a long bull market.
That's exactly what happens. When stocks just keep going up year after year, like after 1949, people forget the difference between investing and speculating. Everything feels safe. Buying any stock feels like an investment.
The media probably fans those flames too.
Oh, absolutely. Brokerages, commentators, everyone starts talking about new paradigms. And then the correction comes, like the tech wreck in 2000.
And people who were just gambling get wiped out and blame the market.
Yep.
They were speculating but thought they were investing. They didn't understand the risks they were taking because they skipped the analysis and ignored the price. It's crucial. If you aren't going to do the enterprising work, you must adopt the defensive strategy. It protects you from yourself. Makes sense. Let's focus on that defensive investor then. How do they build that protection?
First step is asset allocation, right? Stocks versus bonds.
Right.
The basic decision. Graham's advice is simple. Divide your funds between high-grade bonds, or cash equivalents, and high-grade common stocks. And he had a specific rule for the split, the golden rule.
He did. Never have less than 25% in stocks and never more than 75%, and the reverse for bonds. So always keep at least a quarter in each camp.
And the default.
Just a simple 50-50 split, easy to manage, easy to stick to. It forces discipline.
50% in bonds. That sounds really conservative today, especially for, say, a 30-year-old. Advisors now often push 90% stocks. It does sound conservative now, and that highlights a key point. Graham never tied allocation to age. That whole 100 minus your age rule, that came later and got really aggressive in the late 90s bubble. Graham focused on market conditions and your own tolerance for risk.
So it's about the relative value, comparing stocks and bonds at the time.
Precisely. Back in early 72, for instance, the stock market, the DJIA, yielded only about 3.5% in dividends. But you could get high-grade bonds yielding 7.5%. Graham argued the bonds were clearly the less risky choice then, given those numbers.
So you have to constantly assess the current situation, not just follow a fixed age rule. The 50-50 is more about behavioral control.
Exactly. It prevents you from going all in on stocks when they're high and everyone's euphoric, or panic selling everything when they crash. It forces rebalancing. When stocks soar, you sell some to buy bonds, locking in gains. When stocks tank, you sell some safe bonds to buy stocks cheap. It automates intelligent behavior.
Okay, but what about inflation? That eats away at bonds, doesn't it?
It's a huge risk, a major enemy, as Graham called it. We saw it happen dramatically in the 70s and early 80s. The dollar lost more than half its value.
So how does the defensive investor handle that?
That's where the stock component comes in. It's your primary insurance against long-term inflation. Stocks, over time, should offer better protection against rising costs than fixed income bonds. That's a key reason to always have that minimum 25% stock allocation, even if bond yields look tempting.
And for the bond part itself, what's considered high grade?
Stick to the safe stuff. Top quality corporate bonds or government bonds, or tax-free municipal bonds, if they make sense for you.
How do you choose between, say, corporate and municipal bonds?
Purely arithmetic. Look at the yields after tax. If a taxable corporate bond yields 7.5% and a tax-free muni yields 5.3%, you figure out your marginal tax rate. If it's above, say, 30%, the muni bond actually puts more money in your pocket after taxes. You just want the highest net return from the safest possible options.
Got it. Now, for the stock side of that 50-50 split, the defensive investor needs rules here too. 4 of them. Yep, 4 straightforward rules to keep you out of trouble. Rule 1, diversification. How much diversification?
Adequate, but not too much. Graham suggested a minimum of 10 different stocks and a maximum of maybe 30. Fewer than 10, you have too much company-specific risk. More than 30, it gets hard to manage and the benefits kind of diminish. Okay, rule 2, quality. What defines a quality company for Graham? Think big, established, financially sound. He used metrics like minimum annual sales, $100 million for an industrial company back then. These aren't startups. They're prominent players with solid balance sheets.
Rule 3 is about stability.
Yeah, specifically a long history of paying dividends without interruption. He suggested looking back maybe 20 years, like continuously since 1950 in his time. It shows the company can make money and survive through different economic cycles, good times and bad. It's a tough practical test.
And the 4th rule, this sounds like the really restrictive one, the valuation limit, based on the PE ratio.
This is the big one for avoiding bubbles. It's a 2-part rule. First, the stock price shouldn't be more than 20 times the last 12 months' earnings.
Okay, PE under 20, what's the second part?
The price also shouldn't be more than 25 times the average earnings over the past 7 years.
Whoa, okay. Why the 7-year average? And why both rules?
The 7-year average smooths things out. A company might have had one blowout year, making its trailing PE look okay, but its average earnings over a full business cycle might be much lower. Requiring both a reasonable current PE and a reasonable average PE is a strong filter.
And this effectively screens out what?
It basically bans most growth stocks, especially the really popular high-flying ones. If a stock is trading at, say, 40 times its average earnings because everyone expects massive future growth, this rule says, nope, too expensive, too risky for the defensive investor.
So thinking back to the dot-com boom, this rule would have kept you out of stocks like Cisco or Microsoft when they were at their peaks.
Absolutely. They were trading at multiples way, way above these limits. Microsoft fell over 50%. Cisco lost more than 3/4 of its value. A defensive investor following these rules wouldn't have touched them at those prices. They would have missed the huge run-up, yes, but also the catastrophic crash. The rule prioritizes avoiding big losses over chasing big gains.
Okay, so the defensive investor uses these rules to pick maybe 10 to 30 stocks, keeps the 50-50 balance. What about adding new money over time?
That's where dollar cost averaging comes in. DCA. It's the ultimate passive strategy.
Just investing a fixed amount regularly.
Exactly. Same amount every month or every quarter, rain or shine, buy more shares of your chosen stocks or funds. Graham loved this. He called it the strategy used with the most confidence of eventual success.
And the historical tests back that up, even starting before crashes.
Remarkably so. Tests covering decades, including periods starting right before the 1929 crash, showed consistent profits on average over 10-year holding periods, even excluding dividends. It just works because it forces you to buy more when prices are low and less when they're high.
So the simplest way today is just index funds.
Pretty much. Set up an automatic investment, say $500 a month, split between a U.S. stock index, an international stock index, and a bond index. Put it on autopilot. Don't try to time it. Don't check the prices obsessively. It prevents those emotional decisions, that urge to jump in when things look hottest, which is usually the worst time. Which leads us perfectly into the next big topic. That speculative lure, the market hype machine. Yeah, it's always there, packaging speculation to look like easy investment. It preys on greed and impatience.
Like those ads from the late 90s. Click a button and make $1,700.
Exactly. The Ameritrade ad with the housewife, it promised effortless riches, made it look like a video game, and millions bought into it. Online trading exploded.
Day trading became a thing, people quitting jobs.
Right. Guys like Nicholas Burbis, the former waiter, bragging he'd make 6 figures trading 10 times a day, thinking holding long-term was foolish. Even celebrities got caught up, like Barbra Streisand admitting she'd sell instantly if she saw red on her screen. Pure emotion, zero strategy.
And the analysts weren't exactly helping, were they?
Often they were fueling the fire. Henry Blodgett putting a $400 target on Amazon, making it jump 19% in a day. That's not based on fundamentals, that's hype driving price. Or Kramer saying you had to throw out all the old valuation metrics because of the internet. It was madness.
But Graham's core warning remained the same, didn't it? About price.
Always. The really dreadful losses were realized, where the buyer forgot to ask how much. They stopped connecting the price they paid to the actual value they were getting. That's the fatal mistake, repeated over and over.
And it's not just misplaced optimism, sometimes it's outright fraud hidden by hype.
Oh yeah. Graham himself got briefly tangled in the Savold tire mania in 1919, made 250% on day one, but the company was a complete fraud. Stock went to zero within months. The hype completely masked the lack of substance.
And AAA Enterprises in the 60s, same story, different buzzword.
Yep. Sold based on the magic of franchising. Price doubled instantly, then collapsed, went bankrupt. People bought this story, the concept, not the underlying business value. Whether it's tires, franchising, or .com, the pattern is the same.
Even seemingly clever formulas can lead you astray, like that foolish 4 idea.
Right. That illustrates data mining. If you torture data enough, you'll find patterns that look predictive just by luck. The foolish 4 seemed to work for a bit, but the factors weren't causing the outperformance. It was randomness. And thinking a 4-stock portfolio is safe, that ignores basic diversification.
So how do you shield yourself mentally from all this noise and temptation? Graham's Mr. Market parable seems key.
It's probably his most brilliant and useful contribution to investor psychology. Imagine you co-own a business with a partner named Mr. Market.
And he's moody.
Extremely. Manic depressive. Every single day he comes to you and offers to either buy your share or sell you his. Sometimes his price seems fair, based on the business's reality. But often, he's either wildly optimistic, offering a ridiculously high price, or utterly panicked, willing to sell dirt cheap.
So the point isn't to predict his mood, but to react rationally to his offers.
Exactly. You treat him as a servant, not a master. His quotes are just opportunities. If he's freaking out and offering you his share for way less than it's worth, you should consider buying. If he's euphoric and offers you way more than it's worth, you should consider selling.
You decide based on your own assessment of value, not his emotional state.
You absolutely ignore his mood as a guide to value. You only use his offered price if it benefits you. If you start feeling panicked when he's panicked or greedy when he's greedy, you've lost the game. You become his partner in lunacy.
Which ties into the brain science, right? Bull markets feel good, bear markets trigger fear.
Totally. Rising prices give you that dopamine hit. You feel smart, you get addicted. Falling prices hit the amygdala, raw fear takes over. Graham's counter is almost Zen-like.
What was that quote about wishing stocks had no quotes?
Yeah, that the investor would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other person's mistakes of judgment. If you couldn't see the daily price swings, you'd focus on the business.
So for a long-term investor, especially one using DCA, falling prices are actually good.
They are fantastic news. It means your regular investment buys more shares, more ownership for the same dollar amount. The lower prices go, and the longer they stay low while you're buying, the wealthier you'll likely be in the end, assuming the underlying businesses are sound. You have to learn to welcome bear markets, not fear them.
Okay, let's shift gears to the enterprising investor again, the one doing the hard work. Where should they focus their effort? What should they avoid?
First, avoid the obvious traps. Graham warned against buying IPOs. Especially in hot markets, the odds are stacked against you. Also, avoid junky bonds or preferred stocks, unless they are selling at a massive discount to their actual value, like maybe 30 cents on the dollar below par for a high-yield issue. Needs a huge margin of safety.
And the big temptation is trying to be too clever with valuation.
Yeah, the valuation paradox. Complex mathematical models get used most often, where they're least reliable, trying to predict far future growth for popular stocks. Graham found that dependable valuation rarely needed more than simple arithmetic based on proven historical earning power. Projecting decades out is mostly guesswork.
So if not complex models, where does the enterprising work pay off? What are the real bargains?
The classic Graham bargain, the one easiest to identify with some digging, is the net current asset stock, sometimes called a net-net.
Okay, explain net-net simply. It sounds technical.
It's actually quite straightforward. You're looking for a company whose stock is trading on the market for less than its current assets minus all its liabilities.
So current assets are things like cash, receivables, inventory. Subtract all debt, short-term and long-term, and any other claims.
Right. If what's left, the net current assets or working capital, is more than the total market value of the stock,
then you're essentially buying the cash and easily sellable stuff for less than it's worth and getting the buildings, machinery, brand name, everything else for free.
Exactly. You're buying dollar bills for 50 cents with a factory thrown in. The margin of safety is enormous. It protects you even if the company isn't great, just as long as it doesn't completely fall apart immediately.
Did these actually exist often?
Yes, especially after market downturns. Graham found hundreds over his career. He did studies showing that buying diversified baskets of these net-nets and holding them for a couple of years was consistently profitable, even in generally high markets like 1957.
But it takes work to find them, and they're usually boring, unloved companies.
That's the enterprising effort. You have to sift through the bargain bin. They disappear in bull markets, but reappear when pessimism returns, like after the 69-70 decline. The reward comes from that diligent searching.
What about growth stocks for the enterprising investor? Still too risky?
Graham thought so, generally. The risk isn't just that the company fails, it's that the growth rate merely slows down, or just doesn't meet the incredibly high expectations baked into the stock price. The higher the expectations, the further the fall.
Like the LCOA example. Great company, grew profits, but the stock price went nowhere for years.
Exactly. In 1959, it sold at 45 times earnings. Insane optimism. Profits did grow, but not enough to justify that starting price. By 1970, the stock was half its 59 high, while boring old Sears had tripled. Overpaying for growth, even if the growth happens, can kill your returns.
It comes back to that emotional trap valuing hype over financials, like Cisco versus Cisco.
Perfect modern example. Around 2000, Cisco was the sexy internet infrastructure play, sky-high valuation. Cisco delivered food, boring as dirt, steady profits. Cisco crashed, lost 75% plus sake. Cisco chugged along, gained over 50%. People valued the exciting story internet over the boring reality, sloppy joes. The enterprising investor looks past the story to the numbers.
Okay, so for those who don't want to do all that enterprising work, funds seem like the obvious path. What's the reality check there?
Well, funds offer easy diversification, which is good. But the hard truth is the average actively managed fund fails to beat the market after accounting for its costs.
Why is that? Fees and trading costs mostly. Research consistently shows two things. Higher expenses lead to lower returns for the investor, and funds that trade more frequently also tend to underperform. All that churning costs money and often doesn't add value, and chasing the hot fund is a bad idea.
One of the worst. Performance doesn't persist reliably. Today's winner is often tomorrow's loser. Remember the top tech funds of 1999? They cratered soon after. You're usually buying after the best gains are already gone.
Is there a reason why successful funds often falter?
Yeah, it's called asset elephantiasis. A fund does great, attracts billions in new money. Now the manager has a problem. They have too much cash. They either have to buy more of their existing holdings, potentially pushing prices up, or buy stocks they didn't initially love, diluting quality, or just sit on low return cash. Their size becomes an anchor.
So if active funds are tricky, what about getting help from a financial advisor? Advisors can be valuable, especially for planning, but Graham was adamant you absolutely must investigate the advisor thoroughly before handing over your money. Check their background, understand how they get paid, ensure their fees are reasonable. Never delegate that responsibility. What key questions should you ask? Two crucial ones. First, what kind of average annual return do you think is realistic for my investments? Be wary of anyone promising consistently high returns, like over 8 or 10% long-term. It might signal excessive risk-taking. And the second,
ask for their Form ADV. That's the official disclosure document filed with regulators. It details their services, fees, conflicts of interest, disciplinary history. If they hesitate or refuse, walk away. Fast. Okay, we've covered a lot. Let's bring it back to the core concept that ties everything together. Margin of safety. This is the bedrock, the central concept of intelligent investing. It's the cushion between the price you pay for a security and your estimate of its intrinsic value.
it's the buffer for being wrong.
Exactly, because you will be wrong sometimes. Your analysis might be flawed or bad luck strikes the company. The margin of safety ensures that mistakes don't bankrupt you. It's why you buy $1 worth of assets for 50 cents, like with the NetNets. You're building in protection.
And ignoring it, paying too high a price, has devastating consequences, like that cost of loss idea.
Absolutely devastating. If you lose 50% in year one because you overpaid during a bubble, you need 100% return just to get back to even. That analysis showed that even earning a high 10% return annually after that 50% loss, it would still take over 16 years just to catch up to someone who simply earned a steady 5% from the start. One big loss wipes out decades of potential compounding. Price matters immensely.
So ultimately, risk isn't just out there in the market volatility.
No, a huge part of risk is in ourselves. It's overestimating our knowledge. It's overconfidence in our ability to handle a downturn without panicking. If you don't know your own limitations, if you can't control your emotions, it almost doesn't matter what you own. The type of investor you are determines your real risk.
Buffett captured that Graham and Doddsville attitude, right? Buying the business, not the stock.
Perfectly. He said those investors take less risk than average precisely because they demand that margin of safety. They focus on the underlying value of the business and exploit Mr. Market's irrational prices, rather than getting swept up in them.
So wrapping this all up, if we accept we'll make mistakes, what's the final piece of actionable wisdom? It's realizing you can control the consequences of being wrong, even if you can't eliminate the probability of being wrong. So the final question you have to ask yourself is, can I structure my investments and my behavior diversification, valuation discipline, margin of safety, so that when the inevitable storms hit, when Mr. Market is screaming panic, I can look at my portfolio and say, calmly, this too shall pass. Which means resisting the urge to chase fads, staying diversified, and sticking to your plan.
That's the essence of it. Build a fortress, stick to the rules, and let the madness of the crowd wash past you. That's how you survive and thrive as an intelligent investor.